It is a pleasure to welcome our industry expert, Mr. Hariharan today. Sir, are short-term debt funds linked to the market?
They are. So all these funds, so barring the overnight fund. So in an overnight fund, what happens is that the fund manager invests in what is called as an overnight security, which means these are securities which have a maturity of only 1 day. So from a risk perspective, as I talked of interest rate risk, the longer the duration or the maturity of the instrument, more is the impact of the change in interest rate. If it's a 1 day security, there's hardly any impact. So it's actually one of the safest debt mutual fund schemes. So at previously, before the launch of overnight funds, liquid funds used to be called as the safest debt mutual fund. So typically, when you look at all the debt mutual funds which participate in debt securities which have less than 1 year kind of maturities, the impact of change in interest rate will be very low. But of course, there could be credit risk. Now, all that depends on how the portfolio is constructed, what mix of papers the fund manager has taken. But I will speak from a general perspective. Short-term funds typically as a mandate by SEBI that the fund manager has to maintain what is called as the duration between 1 to 3 years, which means if the RBI changes interest rate by 1%, and let's hypothetically assume that the fund has a duration of 2 years, it means that 1% change in interest rate will bring a 2% change in price, but it will be in the opposite direction. So if RBI increases rates by 1%, the price will fall by 2%. So the NAV will fall by 2%. Similarly, if RBI reduces the rates, the NAV will go by 2%. But it will get impacted only by 2 or 3% maximum. But if you go to a longer duration fund, which typically has a duration of 7 years, 8 years, or 10 years, for every 1% change, there's going to be 8 or 10% change in the price. So from a relative perspective, short term will have lesser impact of change in interest rates. Again, important to look at what is the credit profile of the fund. How much percentage of the assets are into AAA, AA kind of assets. Okay, but generally speaking, on a relative basis, more riskier than liquid funds and 1 year segment kind of funds, less riskier as compared to a much longer duration kind of fund. But it will get impacted by market movement.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.